profits method. We discussed about the weighted average profits method. We also discussed about the super profits method. Yes? Let us do one more problem on super profits method. Write down. Profits of 2010. Profits of 2010. 2,10,000 rupees. 2,10,000 rupees. Profits of 2011. Profits of 2011. 2,20,000 rupees. Profits of 2012. Profits of 2012. 1,55,000 rupees. 1,55,000 rupees. 2013. 1,90,000 rupees. So profits of 2010 were 2,10,000. 2011 was 2,20,000. 2012 was 1,55,000 rupees. And 2013 it is how much? 1,90,000 rupees. Write down. In 2010, an asset was sold. An asset was sold and profit of 10,000 rupees. Profit of 10,000 rupees was included in the profits. Was included in the profits. Full stop. In 2011, closing stock was overvalued by 20,000 rupees. Closing stock was overvalued by 20,000 rupees. Full stop. In 2012, additions made to the building. Additions made to the building. Additions made to the building. 20,000 rupees. Additions made to the building. 20,000 rupees. Don't write 20,000, write 25,000 rupees. Additions made to the building. 25,000 rupees was charged to P&L account. Was charged to P&L account by mistake. Was charged to P&L account by mistake. Full stop. Depreciation is charged on buildings. Depreciation is charged on on buildings at the rate of 10% per annum. At the rate of 10% per annum. Full stop. In 2013, an abnormal loss of 15,000 was debited to P&L account. Abnormal loss of 15,000 was debited to P&L account. 15. So you are given list of profits, then you are given certain adjustments. Continue. Goodwill is valued at 2 years purchase of super profits. Goodwill is valued at 2 years purchase of super profits. Full stop. Normal rate of return 12% per annum. Capital employed in the business 10 lakh rupees. Calculate the value of goodwill. How will you solve the problem? I think I told you yesterday, under super profits method, goodwill is calculated by a simple formula: super profits per annum multiplied by number of years of purchase. How do you calculate super profits? What do you mean by super profits? When the profits of the firm are more when compared to the profits of a competitive business in the same industry. If somebody else was doing business in the same industry, with the capital which you have employed, how much they would have earned and how much you have earned, you compare both of them to understand what is the super profits we are earning. In this problem, the partners have invested 10 lakhs in their business. If others would have invested the same 10 lakh in the industry, they would be earning only 12% return on their investment. They are able to earn only 12 rupees for every 100 rupees invested. So that is a profit which others could have earned with the same capital. We have to find out what is our firm earning from 10 lakhs invested. If we are able to earn more when compared to others, the extra amount which you are able to earn when compared to others is called as super profits. And that multiplied with number of years of purchase will be the value of goodwill. So before we do that, we have to calculate something called as future maintainable profits. I told you yesterday, goodwill valuation actually depends upon expected profits. Because we cannot expect profits, we take the help of past profits. We see the past as a mirror in which we can see our future. So we take the past profits and we try to find out, have the past profits been affected because of certain events or certain transactions which are not going to recur in the future. We try to see if in the past some transactions and events have happened because of which the profits have been affected, but you don't expect those events and transactions not to recur in the future. We nullify the effect of those transactions and events on the profits, and then we use those profits as future maintainable profits. Is it clear? Let us start doing it. And if there are any errors in past profits, we have to rectify the errors and then use the profits for calculation of value of goodwill. So let us start with calculation of future maintainable profits. particulars 2010, 2011, 2012 and 2013. These are the years you have to consider. 2010, 2011, 2012 and 2013. Profits before adjustment. Can you tell me what are the profits? 2010 was how much? 2 lakh? 10,000. 2011? 2 lakh? 2 lakh 20,000. 1 lakh 55,000. 1 lakh 90,000. Now you are given some additional information about 2010 profits. See the additional information given to you. In 2010, the firm has sold an asset because of which we got a profit of 10,000. Okay. Now, see, only firms which can generate profits from their business when compared to others, they will be entitled to goodwill. You sell away an asset, you are getting profits. You cannot say, I should get some goodwill, because the person who is buying your firm, who wants to invest money in your firm, he is looking at your profit earning capability from your business, not from your assets. I would understand. Hence, the profits which we are going to use should be from the business, not from other activities. Okay. So in 2010 we sold away an asset, we got a profit. But is this from your business? No, it is from some other activity. So profits from some other activities, if you are earning, you cannot ask goodwill. No. When will goodwill valuation come into picture? Yesterday I gave you an example. When you want to sell away your business, you would like the purchaser to give you some extra amount over and above the value of your assets and liabilities. Yes, you are demanding some goodwill then. So in such a case, the buyer is not going to consider the value of is going to only consider the value of assets and liabilities, and is going to consider whether your business can earn him profits more than others. Only then will give you some goodwill. Okay, that is why we have to remove the profits which were included in the year 2010. And it is now, do you keep selling assets every year? It is something which happens once in 10 years, once in 15 years. Okay, so you have to remove that profit. Less profit from sale of asset 10,000. It's like an abnormal gain which is not expected to recur in the future. Hence I am nullifying the effect by subtracting it from the profit. Next, see 2011. 2011 a bigger mistake happened. What happened in 2011? Closing stock was overvalued by 20,000. Now, if you increase the value of closing stock, what will happen? If you increase the value of closing stock, please imagine a trading account. If you increase the value of closing stock, total of the credit side will increase. Automatically profits will also increase. Yes or no? So how did you increase your profits? By making more sales or by artificially increasing the value of closing stock? You have created more profits by artificially increasing the value of closing stock. Is it correct to increase profits artificially? No. Now if you say yes, then what I'll do is, instead of writing 2 lakhs in stock, I'll strike it off, I'll write 5 lakhs in stock. Tomorrow I'll write 10 lakhs in stock. Then after that I'll write 1 crore in stock. Because you're saying it's okay to increase the value of stock, no? If I keep increasing the value of closing stock, what will happen? My profits will keep increasing. Profits means profit which you have got because of selling goods, not by increasing the value of your closing stock. Profit means what? Profit from selling of your goods to outsiders. Just by increasing the value of closing stock, if you are showing profits, it is not correct. You are actually doing cheating, you should be put into a jail. Okay. So let us remove the profit which have been included in 2012. Less overvaluation of closing stock. Now please imagine, if you increase the value of closing stock, trading account credit side increases. If trading account credit side increases, other items constant, automatically profits will increase. So by increasing closing stock, you have wantedly increased the profits of 2011. So whatever increase you have shown, now you are reducing it and you are correcting the profits. Is it clear? So here I will say less. Now, but please listen very carefully. This mistake will have an effect not only in 2011, it will also have an impact on 2012 profits. How? Closing stock of 2011 will become opening stock of 2012. Opening stock of 2012. Now, if you have increased the value of closing stock of 2011, automatically the value of opening stock of 2012 will also be increased. Where do you show opening stock? Debit side of the trading account. Expense. If you inflate an expense, what is going to happen? Profits will decrease. So artificially, profits of 2012 were reduced because of overvaluation of opening stock now. So now we have to reverse the impact. Add overvaluation of opening stock. Overvaluation of opening stock. Overvaluation of opening stock 20,000. Are you able to understand? Closing stock of 2011 will become opening stock for 2012. Opening stock of 2012, you are writing excess amount. More than what you should have written, you have written 20,000 extra. So what will happen? Expense side will increase, profits will reduce. That means you have wantedly shown less profit. This is a mistake. You have shown less profit. Now you have to increase the profit by adding it to it. Is it clear? So 20,000. 2013 there is no impact. So that is an error which will have an impact on profits of 2 years, 2011 and 2012. We have rectified both the mistakes. Last, 2013, what is the error? See, in 2013 there was an abnormal loss of how much? No, I think 2012 there is one more transaction. Read that. In 2012 there was an addition made to a building. How much? In 2012 there was an addition made to building, 25,000 rupees, but which was wrongly debited to profit and loss account. Now you already have a building. The partnership firm has a building. They have added one more floor or they have added one more room. It is an asset. You have spent 25,000 on it. If you have spent 25,000 on an asset, the value of building should be increased. You are spending money and in return you are getting an asset. So that 25,000 should have been debited to building account. It should not have been debited to profit and is it a nominal account, additions to building? Can you kill that amount by transferring it to P&L account? No. It should have been debited to building account and gradually depreciated. Gradually what? Depreciated. But what we have done? Instead of adding it to building account, we have debited it to profit and loss account. We have treated a capital expenditure as a revenue expenditure. This is a mistake we have done. We should have treated that expenditure as an asset, but we have treated it as an expense. It should not have been debited to P&L account. But what we did? We have debited it to profit and loss account. Now tell me, because of our mistake, what is the impact on profits?
Profits will decrease.
25,000 should not have been debited, but you have debited P&L account. Profits would have been reduced. Now what should I do? Increase the profits. Add wrong treatment of capital expenditure. How much? 25,000. But the error doesn't stop here. Suppose, now we have rectified the error. 25,000 should not have been debited to P&L account. It should have been debited to building account. So what we did? We gave a wrong debit to P&L account. Hence we gave a credit to P&L account and will give a debit to the building account. If building account was correctly debited, you would have charged depreciation. How much you would have charged? 10%. If this 25,000 was not debited to P&L account, if it was debited to building account, then you would have charged depreciation of how much? 10% on that 25,000. Yes? So we have to now calculate depreciation. 25,000 to 10%. How much is it? 2,500 less depreciation which has escaped. 2,500. 2,500. I'm assuming straight line method. In 2012, depreciation escaped 2,500. Similarly, in 2013 also it would have escaped, no? Because expenditure was debited to P&L account. If the amount was debited to building, 2012 you would have charged depreciation. 2013 also you would have charged depreciation. So now I have rectified my mistakes. Is it clear? Depreciation which has escaped. We have subtracted the depreciation figures now. 2013, see the last adjustment. What does it say? In 2013, there was an abnormal loss of how much?
15,000.
What's it out? That is what I am saying. I have assumed SLM method, straight line method. You will learn about it when we come to depreciation chapter. Okay? Under SLM method, depreciation per annum remains the same. 10% no, 10% on cost. It is not 10% on opening WDV. Okay? Next, in 2013, what did we have? Just see. Abnormal loss of how much? 15,000 rupees was debited to the profit and loss account. Abnormal loss are not expected to recur. So you have now add it back. Add abnormal loss. How much? 15,000. Now you will get adjusted profits, or we can say future maintainable profits. How much do you get? 2 lakhs. 2 lakh. How much here? 1,97,500. 2,02,000. 2,02,500. Now, before I continue, I'll explain one by one all the adjustments again. In 2010, we got an abnormal profit which is not expected to recur, hence I have subtracted. In 2011, closing stock was overvalued. If you overvalue closing stock, profits are overstated. So to reduce the profit, I have reduced 20,000 here. If you overstate closing stock, next year's opening stock is also overstated. If you overstate opening stock value, opening stock is an expense. If you increase the value of expense, profits are automatically reducing. Hence, to increase the profit, I have added 20,000 here. Is it clear? In 2012, some additions were made to the building by spending how much? 25,000, which was wrongly debited to profit and loss account. 25,000 should not have been debited to P&L account, but by mistake we have debited it. That means we have reduced the profits by mistake. So after rectify my error, what will I do? Add it back to profits. That is why I added 25,000 rupees to the profits. Now, if the correct treatment was given to building, definitely 2,500 rupees of depreciation would have been charged per annum. 25,000 into 10%, 2,500 would have been charged as depreciation. Hence, I am charging depreciation. Because of not debiting building account, depreciation has escaped. Hence, whatever depreciation has escaped, I am now providing the depreciation. 2,500 in 2010 and 2,500 in 2012 and 2,500 in 2013 also. In 2013, there was an abnormal loss which is not expected to recur in the future. Hence I have added that loss back to the profits to arrive at future maintainable profits. Now calculate the average. Average. Simple average you will calculate. 2 lakhs. Average is 2 lakh. 2 lakh plus 2 lakh plus this by 4. 2 lakh rupees per annum is the profit. Next, this is your future maintainable profit. Now suppose the problem says in the future additional expenditure of 20,000 is expected, which was not happening in the previous years. Then what should you do? 20,000 subtract from here. If the problem says in the future we are expecting that certain expenditure will increase by 20,000, which was not there in the past, when you are calculating FMP, future maintainable profit, then you will say 2 lakh minus 20,000. It will be 1,80,000 rupees. But in this problem, have you been given any increase in expenditure expected? The answer is no. So let us continue now. You will write goodwill is equal to super profits per annum into number of years of purchase. Super profits per annum into number of years of purchase. The problem provides what is number of years of purchase? 2 years. Into 2. Now calculation of super profits. Step 1. What is step 1? FMP, that we already know. Future maintainable profits 2 lakh. Step 2. Capital employed, given the problem, how much? 10 lakhs. Now, step 3. I want to know if the same capital is invested by somebody else in a similar business, how much can they make as profits every year? Normal rate of return is how much? 12%. So normally others, if they invest 100 rupees in this type of business, they are able to earn only 12 rupees as profits. So normal profits. It is 10 lakh into 12%. How much is it? 1,20,000. Step 4. Super profits is equal to 2 lakhs minus 1,20,000. 80,000 per annum. Substitute here. 80,000 into 2, 1,60,000 rupees is the value of goodwill. Next, write down fourth method, capitalization method. Capitalization method, underline. Capitalization method, underline. Under this method, goodwill is calculated by the following formula. Under this method, goodwill is calculated by the following formula. Right, goodwill is equal to capitalized profits minus capital actually employed. Capitalized profits minus actual capital employed. Or you can also say the formula, you can change the formula like this, you can write normal capital employed minus actual capital employed. Normal capital employed minus actual capital employed. Now, how do you calculate normal capital employed or the capitalized profits? Write down normal capital employed or capitalized profits is equal to normal capital employed or capitalized profits is equal to normal capital employed or capitalized profits is equal to average annual profits divided by average annual profits divided by NRR percentage. Average annual profits divided by NRR percentage, normal rate of return percentage. You will get the capitalized profits or you will get the normal capital employed. So how do you calculate it? Average profits, annual profits divided by NRR percentage. You get the normal capital employed, or it is also called as the capitalized profits. Okay, write down. Write down a problem now. You will understand the meaning in this problem. Write down. Average annual profits earned. Average annual profits earned 1,20,000 rupees. ₹1,20,000. NRR percentage. NRR percentage. 10%. Actual capital employed. Actual capital employed 9 lakhs. Calculate the value of goodwill. Calculate the value of goodwill. Calculate the value of goodwill. Okay. Now, write down. Goodwill is equal to normal capital employed minus goodwill is equal to normal capital employed minus actual capital employed. Normal capital employed minus actual capital employed, or we can also write it as capitalized profits minus actual capital employed. Both are one and the same. So what is the value of goodwill equal to? Goodwill is equal to normal capital employed minus actual capital employed. Normal capital employed, what is the formula I have taught you? Average profits divided by NRR percentage. What is the average profits we have earned? 1,20,000 divided by 10%. How much is it? Now what is the meaning of this 12 lakh? Every year our firm is earning 1,20,000 of profits. If others, not our business, if other businessmen want to earn the same profits, how much they have to invest in the business? NRR percentage is 10%. What does that mean? Suppose if somebody is investing 100 rupees, they are getting a profit of 10. Others in the industry, by investing 100, they are only getting 10. If they want to earn our profits, that means they have to earn 1,20,000. How much should they invest? For every 100 rupees, they are earning 10 rupees. How much should they invest on our profits? 1,20,000. They have to invest 12 lakh. But how much did we actually invest to earn that 12 lakh? To earn that profit, we have invested only 9 lakh. Others, to earn our profits, they have to invest 12 lakh. But we are earning the same profits by investing only 9 lakh. So we are investing invisible capital called as goodwill. We have put in our effort in place of money. The difference is our goodwill. Is it clear? Right now, goodwill is equal to 12 lakh minus 9 lakh, 3 lakhs. Is it clear, everyone? This is how we calculate the value of goodwill. Next, write down annuity method. Have you learned annuities in your mathematics class? Yes. Annuity method. Under this method, goodwill is calculated by the following formula. It's calculated by the following formula. Right now, goodwill is equal to annual profits. Goodwill is equal to annual profits multiplied by present value annuity factor. Goodwill is equal to annual profits multiplied by present value annuity factor. Okay. Write down. Under this method, goodwill is the sum of present value of expected profits. Goodwill is the present value of the sum of present value of expected profits. So we are going to estimate our future profits and we are going to find out their present values and we are going to do the sum of the present value of expected profits. That will be the value of your goodwill. Okay, write down. Present value annuity factor depends upon rate of interest and the number of years. Present value annuity factor depends upon rate of interest and number of years. Write down a problem. Annual profits 30,000. Annual profits 30,000. Expected to continue for next 5 years. Expected to continue for next 5 years. Rate of interest rate of interest 10% per annum. Calculate value of goodwill. Calculate value of goodwill. Alright. Goodwill is equal to, what's the formula? Goodwill is equal to annual profits into present value annuity factor. Goodwill is equal to annual profits into present value annuity factor. Goodwill is equal to annual profits into present value annuity factor. Now, annual profits we know, right? Goodwill is equal to 30,000 into question mark. So, how do you calculate that present value annuity factor? Write down below that. Present value annuity factor is equal to, look at the board. This is how we calculate the present value annuity factor. Present value annuity factor is equal to 1 divided by 1 plus 0.10 whole power 5 plus 1 by 1.10 whole power 4 plus dot 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 1 by 1 plus 1.10 whole power 1. Write down. Present value annuity factor is equal to 1 by 1 plus 0.10 whole power 5 plus 1 by 1.10 whole power 4 plus dot 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 1 by 1.10 whole power 1. How do you calculate this? Use your calculator. I'll help you to do it. Press on button. Type 1 divided by 1.10 equal to, how much did you get? 0.9090. You got no? Press M plus button. Don't press any other button till that time I tell you to press it. Press M plus button. You have pressed, don't press 2 times, 3 times, 4 times. You have pressed 1 time M plus button now. Again press equal to button. How much do you get? 0.8264. Again press M plus. Again equal to. You got some value? Yes. Press M plus. Press M plus. Third time you press M plus. Again press equal to. 0.682. Press M plus. Again press equal to. Press M plus. Now press MRC. How much? 3.790. This is called as the present value annuity factor. It is sum of annual present value factors. Cumulative present value factors is called as present value annuity factor. So you got 3.7907. Now go back to your formula. The formula is waiting. You'll say 30,000 into 3.7907. How much do you get? 30,000 into 3.7907. That is the value of your goodwill. $30,000 into 3.7907, you'll get 1,13,721 rupees. That is the value of your goodwill. Don't go too deep into this method because right now you don't have sufficient knowledge of time value of money. When you come to IPCC level, financial management, you learn in detail about time value of money. There you will understand what is the meaning of this present value factor, present value vanity factor. It will take us at least 2 to 3 hours for you to properly understand what is present value factor, present value vanity factor. I think that is not required for CPT account syllabus. Is it clear? So these are the various methods in which goodwill is valued. Okay. With this we complete goodwill valuation. How to arrive at the value of goodwill. These are the various methods which we have to discuss. And in your textbook, I think you have a complete chapter on valuation of goodwill, determination of value of goodwill. Please do those bits on your own. Okay? And we'll take up the doubts also. Most of the doubts I think I have cleared. I know what problems are there in the textbook. In all my problems I have kept all those points where you normally get a doubt. So if you have attended, if you have listened to the class properly, if you have practiced what problems I have made you to do properly, you should be able to solve all the problems which are given in the textbook automatically. Is it clear? Now, we'll stop for the day.